Welcome to another edition of Money Says. This one's called Macro Mondays. Well, the market's been in an absolute turmoil over the last few days. All of the major indices are down. The investing community is basically spooked by fears of a recession. Really, two driving factors to that: the manufacturing data and the labor data. But let's look at these data points in more detail. There are some commonalities between now and the times that there was a recession, and there are some pretty big differences. Also, what this video will help you do is assess the possible scenarios that might take place from here on. Pretty much a bloodbath all around. The S&P is down by 3%. The small cap index down by the same, roughly around 3.3%. NASDAQ and Dow are both down. Bitcoin's down by a whopping 10%. Yesterday it was about a little more than 10%. If I believe it reached about 49K in intraday today. So bloodbath all around. There's really nothing that's a good sign at this point. The 10-year rate is at 3.77, which is down by a further 0.5%. And my favorite wicks at this point, it's jumped to 34.94. Now wicks is a measure of volatility, and we'll look at these indicators in a little bit more detail in the following section. But it's roughly been around the 15 to the 18 mark in probably all of the last 52-week period, and that's jumped to about 34.796. It was actually higher when markets open. So that's the macro indicators bit. Now, if we look at the what people are, the differences perhaps in the last few days ago versus now, any drop in the 10-year rate, which is related to the valuation of many companies, and also the fact that it's a gauge for Fed cuts, mortgage rates, and so on and so forth, was a good sign, but not anymore. Now there's more pessimism and fear. And actually, on that note, if you look at this article, if you just Google CNN markets fear and greed, they do a pretty good job at kind of highlighting the various indicators that point to fear, and so that's what's driving the market. So any drop in these in the 10-year yield, ordinarily before last week would have caused a increase in some of the stock prices, but not anymore. It's now pointing to investors are now looking at this as a measure of recession. So that's a bit about the macro indicators and the fear index, and this is really the reasons why the stock market and the 10-year yield is where it is. One, and I made a separate video on this on the PMI index, but the PMI index in July reached 46.8, which is contracting at a faster rate month over month, and anything less than 50 is perceived as a bad news story. So where things that peaked in I believe in March of 2024 were looking in okay shape in April, the last 3 months were seen as a negative sign, in that there are some industries that were viewed as a risk from a demand standpoint, and an overall health standpoint, and that was one of the factors that caused the drop. Then shortly later there was the unemployment data that came out, and so unemployment reached 4.5%, and that's essentially what drove the markets downwards. And that triggered what was called as the SAM rule, which we'll take a look at in the following section. Also, the new jobs that were created were also very low. So non-farm employment added 114,000 in July, and which is well below estimates. So those two things put together dropped that crazy drop in all the major indices. Now, what is the market expecting? So I believe, if you were to look at this data maybe a couple of weeks ago, this would have said, and this is the CME Fed Watch tool. This would have said probably these rates were a little less little less trending towards the lower end than they are today. So there's more than 80% probability that the Fed will cut interest rates by 50 basis points by September. So if you look at the current rates, they're 525 to 550. That's the target rate by the Fed, and the target rate prediction by September, which is the next meeting, is 475 to 500. So which says that there is a possibility, higher than greater possibility, that there would be a 50 basis point cut, not a 25 basis point cut. Following on, there's more than likelihood that the Fed will cut once, maybe twice. But if you look at all the way up to December, so at the end of December, there's a 50% chance, if you add up the 44.7 and the 9.7, there's more than a 50% chance that there would be a 125 basis point cut between now and the end of December, which if you divide by 25 basis points, which is most likely the amount that the Fed would cut interest rates by, it points to about 5 to 6 cuts, or 5 to 6 cut values. So that's what the Fed Watch tool and the investing community is now seeing. But now let's just look at the some of the commonalities. So the unemployment index, which was one of the biggest driving factors of this drop, pointed to 4.3%. And because this went to 4.3%, it triggered what was called as the SAM rule. The SAM rule is a signal that relates to the start of recession when the 3-month moving average of the unemployment rate rises by 0.5 or 50 basis points relative to its low during the previous 12 months. Now this is where the SAM rule sits at the end of July 2024, 53 basis points. And if you look at this was the start of COVID, end of 2029, start of 2020, of FY 2020 or CY 2020. We're at the very sort of start of it, and so the SAM rule has been very accurate in predicting a recession, but it's not every time that the SAM rule has kicked in that the recession has always happened. So it's one of the indicators that the investing community is looking at. Whether that will happen or not is yet to be seen. Number one, S&P is at 5.2, and if you compare it to the times during COVID, CDC had called it a pandemic, so roughly around this time frame. So around February, I believe mid-February was when S&P peaked, and then it dropped, pretty much cratered below 2.5 before it started to resume its ramp slowly. And so that's what happened on the S&P side, and that was correlated or inversely correlated by the increase in the VIX. So the VIX had increased to crazy amounts around here, and if you look at this little green line, that is the S&P embossed on it. It dropped it had an inverse relationship. And that inverse relationship is also evident now. Having said that, though, the VIX has reached these levels previously, so it's only a matter of time before we'll see if this persists or not, or if this was a false alarm. Although the two big reasons of these drops, as we saw previously, was the SAM rule, which was caused by the labor data, and the PMI index. But let's look at the sector action. And so the first three charts, so 1, 2, and 3, are compared to 2019, so the end of 2019, after which COVID was declared as a pandemic. And as we see, even if you look at the first month and compare it to the extreme right chart, which is today versus the end of July of 2024, Technology has taken a huge drop. It's minus 8.6%, and so that's where it's not just labor data, and labor data obviously plays a part in it. The manufacturing index has a huge part to play in this, but it's already recorded an 8.6% drop. Now, if I compare that to the total drop that I saw in Q1, that was at 12%, minus 12%. So things like, supposed overvaluation, especially in the field of AI, has a big part to play in it. When there's huge amounts of downturn, investors pull back on things like energy. People start to travel less. They start to consume less electricity. They're on the road less often, so on and so forth. So energy had a big drop, so 10%, 11% in the first year, which you can compare that. It's sort of comparable to the extreme right hand chart of minus 8%, but it reached minus 50% over the quarter. Consumer discretionary also dropped. Finance dropped a lot, where finance has sort of been holding ground, although that's also dropped by 7%. Discretionary, we said that dropped about 20%, although discretionary is around 8%. So that's how the sector action has played. It's only a matter of time whether to see what happens. Just in conclusion, everybody, in my mind, if the Feds cut interest rates before they enter the September meeting, that would spook the market. That would definitely say that the economy is in trouble and there would be continued sell-off. If they don't, which is the more likely scenario, we might see a recovery. I think, in my opinion, as we saw in the technology sector, it was the downturn or the cuts or the sell-off were more dramatic than we've seen in the earlier periods when there was a recession. And so if we continue to see good earnings coming out of this week, so Palantir, which is scheduled to report earnings, and SMCI is also scheduled to report earnings. If both of them report good earnings, we might see a shift in the way investors see this data, and we might see buying activity. We might see Bitcoin being holding to its 54K support and rising from here, or we might see more pessimism creeping in. But that's it, guys. Hope this was helpful. Please give it a like, thumbs up, and subscribe to the channel if you find this content helpful. I'll see you guys with more things coming up in the future. See you all. Have a good trading week.